In this video, I'm going to provide an up-to-date analysis of every single stock I own. Not only does this include my dividend portfolio, which I regularly cover in these updates, but my other two investment accounts as well. Let's roll the intro. My name is Zach. You should leave a like and subscribe to the channel if you enjoyed the video. Throughout this portfolio update, I'll be using my own dividend investing software, which is available at dividenddata.com. It allows me to analyze my portfolio, track my dividend income, get news on my stocks, calculate valuations, and conduct in-depth research on companies. If you like what you see, then sign up at dividenddata.com. Link in the description and pinned comment. Now let's dive into my portfolio. My current dividend portfolio value is $110,694, which is a 30.8% total return on dollars invested. This has rebounded from my last update where my total return was 24.85%. Most of my companies have increased in value over the past few weeks, except for Kimberly-Clark and Walgreens, but we'll analyze every single stock later in the video. The diversification of my portfolio has remained unchanged, except that Disney has been recategorized to communication services instead of consumer cyclical. This change makes communication services my largest sector. I've limited my buying at this time. I bought one share of Disney at $129.26 and two shares of Intel at a cost per share of $45.10. Aside from this, I continued reinvesting dividends, which you can see here. Speaking of dividends, I just had my largest month of dividend income ever. In March, I earned $359.65 in dividends. This gave me a 3-month rolling average of $308.34. In April, I've already earned $70.29. Notable dividends include $27.90 from Chevron, $132.96 from ExxonMobil, $16.81 from Microsoft, $57.78 from Walgreens, $29.98 from 3M, $21.05 from PepsiCo, $12.93 from Coca-Cola, and $57.36 from Kimberly-Clark. Upcoming dividends include $46 from Federal Realty, $110 from Altria, and $141.98 from AT&T. In total, I've earned $5,211 in dividends and $995 so far this year. AT&T and ExxonMobil are the largest contributors to my dividend income. The dividend snowball is rolling. Now let's get to the topic of the day. I'm going to analyze every single stock I own. This includes my dividend portfolio, non-dividend, and Roth IRA. So stick around for the end of the video to see some of my lesser discussed investments. I'll provide a brief insight into each stock's current business conditions, future, competitive advantages, and current valuation. To start, I'm going to go through my dividend portfolio sorted by current value. I have 98.09 shares of the Walt Disney Company, currently valued at $13,594. I'm down 9.45% overall. The company has an iconic portfolio of franchises under Disney, Pixar, Marvel, Star Wars, etc. They have countless characters and intellectual property with deep lifetime connections to audiences. We're talking about millions of heavily invested fans diversified across their brands. This creates a gigantic economic moat around the company. Disney's ability to monetize these properties through merchandise and licensing is unrivaled. Oh, and did I mention that they also have the highest quality parks and resort business in the world, and that they leverage their intellectual property into that as well? Or that they have 129.8 million Disney Plus subscribers only 2 years into launching the service, during a content production shortage I might add, and that they own both Hulu and ESPN Plus with 45.3 million and 21.3 million respective subscribers. So that's a quick overview of their business. But what about the stock? The closure of their parks and movie theaters punished the company's financials. As you can see, their earnings per share has still not fully recovered to pre-pandemic levels. However, they're climbing back strong now. Disney's domestic parks and resorts just posted record revenue and operating income. This was not even at full capacity, and earnings from the parks will keep climbing as they return to normal. Streaming is the major growth driver for the company. They are still so early. The streaming services are expected to reach profitability in 2024, and I have no doubt they will become highly profitable over the next decade. There will be significant experimentation on both pricing and features. They just started introducing mature content on Disney Plus, tested live events, and are planning to launch a cheaper ad-supported tier. The movie business is evolving, but Spider-Man No Way Home proved that blockbuster Marvel films can still rake in money. The current forward PE ratio for 2022 is expected to be 31 and projected to be 20 by 2024. That's when the streaming services are just starting to become profitable too. I'd expect reliably high earnings growth over the following decade. This will fuel consistent dividend increases and share repurchases for investors. If you can't tell, I think Disney is a great long-term investment at current prices. I own 152.67 shares of ExxonMobil, which is currently valued at $12,696. This is a 124.88% total return. I bought this stock during the prolonged oil crash of 2020. I locked in a fantastic dividend yield on cost of 8.6%. Thanks to dividend reinvestment, I've acquired 14.67 more shares, bringing my compounded dividend yield on cost to 9.5%. The profitability of this business is highly reliant on the price of oil. That means ExxonMobil is printing money right now. At $100 WTI crude oil, this company's next earnings report is going to be terrific. Frankly, these companies are cash flow machines above $60. However, I would not advise buying at current prices. With oil companies and commodity businesses, you want to buy when they're deeply out of favor. I'm going to continue collecting and reinvesting my dividends, but am not adding new capital at this time. I own 510.73 shares of AT&T, currently valued at $12,349.51. My total return is negative 5.84%. This stock has been a roller coaster, as longtime viewers likely know. However, that next step we've been waiting for is finally here. Warner Media is actually being spun out and merged with Discovery. I'll be making a video dedicated to this very topic soon. We'll move on to the next company. I own 30.17 shares of Microsoft, currently valued at $9,503. My total return is 22.8%. Microsoft is one of the highest quality companies in the world. They sell subscription enterprise software, have a dominant position in cloud services through Microsoft Azure, and are well positioned for the future of gaming. They own much more, such as LinkedIn, Visual Studio, and GitHub. That's still only scratching the surface. The company is growing earnings at a very high rate, which is likely to continue in the foreseeable future. My strategy with Microsoft is to consistently dollar cost average and buy on dips. I own 44.25 shares of Apple, currently valued at $7,897. I have a 47.19% total return. Apple is one of the highest quality companies in the world. Their product and software ecosystem forms a wide economic moat. I haven't bought any more of the stock since spring 2021, but I think that I wrongfully neglected the company. I should dollar cost average and buy on dips, similar to my strategy with Microsoft. With companies at this level of quality and growth ahead, I want to steadily build up core positions. These are companies I will own for decades. I own 122.24 shares of Altria, currently valued at $6,444.90. My total return is 31.12%. This company is an extremely reliable free cash flow machine. Many people rule out this stock immediately since it's a cigarette company. However, if you're looking for a great dividend stock, Altria is one of the best. It has a high starting dividend yield, which is sustainable based on its free cash flow, and it grows dividend payments steadily every year. The company also performs share buybacks and has massive pricing power to fight inflation and grow earnings. I made a stock review video if you want to learn more about the business and how they're diversifying away from cigarettes over the long term. I own 49.44 shares of Kimberly-Clark, currently valued at $6,181. My total return is negative 1.32%. This is a consumer products company that owns brands like Kleenex, Huggies, Depends, Kotex, Cottonelle, and Scott. It's a reliable dividend grower that has been increasing its dividends for over 49 years. The company has quality brands and an economic moat, but has very limited growth. Its earnings have been hurt recently due to margin compression from inflation. This stock can be a great long-term holding, but you need to buy it cheap. I think that I reached on the company and made a mistake buying so much. Even after the stock's recent decline, you can make the argument that it deserves to fall more. I've been debating selling some of my position and rebalancing it into a better opportunity. I own 124.19 shares of Walgreens Boots Alliance, currently valued at $5,390. My total return is negative 0.46%. This company just fell after Q2 earnings despite beating Wall Street estimates. I think this is a great value dividend stock right now. It's at an over 10% free cash flow yield with a current dividend yield of 4.4%. They've been steadily growing the dividend for decades and reliably grow earnings as well. This is a company I'll be looking to buy more of soon. I made a stock review video on it last year and it's still very relevant. I own 43.66 shares of Federal Realty, currently valued at $5,369. My total return is 69.62%. This is a real estate investment trust that owns first-ring suburb properties in coastal markets, focusing on high-quality locations in growing, high-income, and affluent areas. They mostly own outdoor markets and plazas that rent out to retail stores, restaurants, grocery, offices, and residential. I bought the stock during 2020 when REITs were trading at a significant discount. I locked in a great dividend yield on cost at 5.54%. This is a company that I plan to hold for a long time since they've been consistently increasing dividends for over 54 years. I'm not planning to buy more at current prices. I own 82.42 shares of Kroger, currently valued at $4,734. My total return is 61.72%. I like this company a lot, and it has great dividend growth with earnings growth to back it up. Kroger is making significant investments in automation and online shopping with its automated fulfillment centers. I covered this in detail during my Kroger stock review video. However, I would not buy more Kroger stock at current prices. It's run up too high in price over the past few months. I own 19.7 shares of PepsiCo, currently valued at $3,336. My total return is 33.58%. This is a very high quality company with some of the best beverage brands. They also have great snack brands through their ownership of Frito-Lay. The snack business is their main difference from the Coca-Cola company. PepsiCo has reliable earnings and dividend growth with share buybacks as well. This is a dominant business that has a wide economic moat. However, it's highly valued and trades at a premium multiple for being a slower growth company. It's that reason why I have not been buying more of the company. This applies to many consumer defensive stocks in our current market. Businesses like PepsiCo are great, but don't deserve to trade at such high profit multiples. Just think about it. Do companies like PepsiCo and Coca-Cola deserve to trade at roughly the same multiple as Apple? No. Obviously, Apple is going to grow its earnings at a higher rate. I own 19.81 shares of Chevron, currently valued at $3,256. My total return is 90.67%. The story here is very similar to ExxonMobil. I bought the stock in 2020 when the price of oil was in a major crisis. These profits are highly influenced by the price of oil, so Chevron, like Exxon, is going to print money at current oil prices. However, I like to buy these dividend payers when they're out of favor. I own 21.32 shares of 3M, currently valued at $3,189. My total return is 6.45%. It's fallen over 25% from its 52-week high, and I think offers an attractive opportunity. This is probably one of the best dividend stocks to buy right now. It offers a 4% dividend yield on cost and over 60 years of consecutive dividend increases. It's trading at a 14 PE and has reliable, slow-growing earnings. On top of this, they buy back shares too. I'm going to buy more 3M and will likely make an updated stock review video soon. I own 112.68 shares of Enterprise Product Partners, currently valued at $2,934. My total return is 49.33%. This is a natural gas and crude oil distribution company. They make money on transporting the liquids through their pipelines, meaning they are less directly impacted by the price of oil. As a dividend stock, it's a good value and still offers a reliable 7% dividend yield. The company continually increases its dividend payments on an annual basis too. I'm open to buying more, but would likely do it in a tax-sheltered account since this stock is an MLP and not taxed as a qualified dividend. I own 20.3 shares of the JM Smucker company, currently valued at $2,734. My total return is 13%. This company has a strong portfolio of brands in food, coffee, and pet food. Their earnings and dividends are growing at a pretty solid rate. Of my consumer defensive stocks, excluding Altria Group, I think this is the best value at the moment. I made a stock review video on the company in late 2021, and my thoughts still apply. I own 9.01 shares of Visa, currently valued at $2,052. My total return is 9.74%. This is a company with a dominant market position in digital payments. There are significant tailwinds behind its growth. I made an incredibly detailed stock review video earlier this year and would definitely check that out if you're interested. Visa is a stock that I'm planning to dollar cost average into and make a core position over the long term. It's a dividend growth machine with fast growing earnings while also performing share buybacks. It has huge network effects and crazy high margins. I own 29.59 shares of the Coca-Cola company, currently valued at $1,850. My total return is 45.75%. The story here is very similar to PepsiCo. The company is extremely high quality with a massive economic moat. They own some of the best beverage brands in the world. However, it's a mature company and grows at a slower rate. It's currently valued at a high profit multiple. I'm not buying more at current prices, but would on a sizable dip. I own 7.28 shares of McDonald's, currently valued at $1,797. My total return is 58.45%. McDonald's is a very high quality company with a great brand and reliable earnings growth. I may make an updated stock review video in the near future. This is a very solid long-term dividend stock, but at current prices, I think there are better opportunities. On a significant decline, this is a stock I would definitely look to target though. I own 11.95 shares of the Scott Miracle-Gro company, currently valued at $1,542. My total return is 54.85%. The company sells consumer products for lawn, garden care, and indoor and hydroponic gardening in the United States and internationally. They own popular brands like Scott's, Miracle-Gro, Ortho, and Roundup. These brands help them form an economic moat in their respective product categories. If you go to a Home Depot or Lowe's, you'll notice they have large shelf space. Additionally, hydroponics has been a growing market for the company. Scott's Miracle-Gro has fallen nearly 50% from its all-time high and actually offers an interesting value. Its PE is 16 and its earnings have been growing above 10% annually. It pays a growing dividend with special dividends too. However, I need to do a deeper dive into the company before buying more. I own 21.55 shares of Realty Income, currently valued at $1,521. My total return is 50.33%. This REIT is beloved by many dividend investors because it pays monthly dividends. On top of this, they've been increasing their dividend payouts for over 98 consecutive quarters. It currently offers a 4.1% dividend yield. I made a stock review video in the past and need to do an updated deep dive on the company. My current plan is to just hold and reinvest dividends. In general, I focus less on REITs due to them not being taxed as qualified dividends. I own 7.25 shares of Johnson & Johnson, currently valued at $1,280. My total return is 34.83%. This is an extremely high-quality dividend stock with reliable earnings growth and consecutive dividend increases. They have a strong portfolio of consumer health brands, which I view positively. Their pharmaceutical division is a big profit driver, and their medical device unit has a lot of innovation. However, healthcare is one of my weaker areas of analysis, which is why I haven't been adding much to this position. Also, I read that they are going to be separating their consumer and pharmaceutical business. This is a company I need to do more research on. Finally, the last stock in my dividend portfolio is Intel. I own 21.06 shares, currently valued at $1,036. My total return is 4.47%. I just made a highly detailed stock review video in January. Much of that information is still applicable. In fact, they've announced even more investments to create new fabrication plants. This will allow Intel to become a dominant semiconductor manufacturer. I believe they will be very successful under the leadership of CEO Pat Gelsinger. The company is trading at a cheap PE of 10 and has a 2.96% dividend yield. This is a stock I'll be buying more of over the coming year. So that's all the stocks in my dividend portfolio. Now let's look at my non-dividend portfolio, which may surprise many of you. This account has performed very well and is currently valued at $47,114.73, which is a 322% total return. I have not added any money to this account since 2018. My largest position is Tesla, which I've owned since 2016. I own 25 shares, currently valued at $28,636. This is a total return of 2,350%. Absolutely nuts. The craziest part of this is that I've actually managed to hold on throughout that entire time period. The stock price has been a roller coaster. Based on valuation, I've considered selling it so many times. However, I have a general rule of not selling great companies. I determined that Tesla and its future potential 100% fall into that bucket. That rule has at least doubled my return on the stock. But come on, Zach, its market cap is larger than the next 10 most valuable car companies combined. Yep. Crazy, I know. However, I think you can make a strong argument that over the next decade, Tesla will be the most profitable car company in the world. They are in the middle of a massive ramp up in manufacturing that is only going to increase in the coming years. You can see their earnings are starting to reflect this. The company is generating serious money now and has industry-leading profit margins. Demand for their cars is still far exceeding supply. The path for Tesla to become a highly profitable car company is clear to me. However, I think that the real value add beyond that is in AI and robotics. You could argue that Tesla is the largest artificial intelligence company in the world. They are significantly ahead of the competition in self-driving technology. This is a huge competitive advantage and has the potential to be monetized in many different ways. Also, the pure software and hardware talent working at Tesla can be leveraged on other projects. For example, the Tesla bot. This was announced on their AI day and we'll likely see the first version of this later in 2022. This will take many years to generate any profits for the company, but the future vision is clear. So would I buy Tesla stock at current prices? No, but I'm definitely going to keep holding my shares. I own 34 shares of Berkshire Hathaway, currently valued at $11,744. This gives me a total return of 59.88%. This is, of course, Warren Buffett's company, an investor who I've learned a ton from and talk about frequently on the channel. I'd argue it's one of the best companies in the world and will be successful long after Warren Buffett passes. I'm planning to hold on to this stock forever. Finally, I own 2 shares of Amazon, currently valued at $6,733. This gives me a total return of 154.11%. Amazon is one of the best companies in the world and will be part of owning the future. The distribution system they've developed is one of the most impressive business feats of modern history. Also, the number of Amazon Prime subscribers is massive and their value proposition is only increasing. There is massive pricing power here. There are so many ways to leverage and monetize this e-commerce infrastructure. This doesn't even begin to mention Amazon Web Services, which is a giant in its own right. Amazon is a stock I will likely hold on to for decades. So that is all the stocks in my non-dividend account. Now let's check out my Roth IRA. It's currently valued at $12,753, giving it a total return of 47.17%. My largest position is PRHSX, which I've owned for many years. It's done decently, but it's down over 15% in the past few months. I own 97.58 shares, currently valued at $9,424. This gives me a total return of 73.57%. This is a T. Rowe Price Health Science Mutual Fund. In general, I don't really like mutual funds due to their high expense ratios, but I've continued holding this fund. It gives me diversified exposure to healthcare, which is one of my weaker areas as an investor. This past year, I bought Alphabet and Adobe. I own one share of Alphabet, better known as Google, currently valued at $2,859. I have a total return of 5%. In my opinion, this is one of the best businesses in the world. I think you could make a strong argument it is the best. I'd certainly say it's a better value than Apple and Microsoft at current prices. Alphabet is huge, but if you just look at Google Search, Ads, and YouTube, then the company is still a juggernaut. The reach of Google Search and Google Ads is unparalleled. YouTube is an absolute powerhouse. It's all user-generated content, so Alphabet does not have the cost of content production. It's unrivaled, and the network effects are only getting stronger with time. I own one share of Adobe, currently valued at $468. My total return is negative 8.49%. This is a subscription software company, and I've been a user of their products for many years. They have a dominant position in digital media software, which is a growing industry. This is a great business. As you can see by their earnings growth, this is a subscription juggernaut poised to dominate the next decade. Adobe is a company I'll be looking to buy more of in the future. So that's an updated take on every single stock I own. It took way longer than I expected, so please leave a like, subscribe, and check out dividenddata.com. Don't take any of my opinions here blindly, and be sure to do your own research before making any investment decisions. Thank you for watching Dividend Data. You can sign up for dividenddata.com to use this software and join a Discord community of like-minded investors. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Link in the description. Please leave a comment below, and thank you for watching.